Well, today is a very exciting day because I have created new positions. And new positions are always exciting because you're filled with optimism and hope, and you expect things are going to go well, and you start to anticipate all the money you're going to make. And it's good, happy days. And then occasionally reality sets in, and a few days or a few weeks later, you might have to start picking up the pieces, and you might be cursing, why did you get in at that time, at that price? That was a terrible decision. But hey, today it looks good. So today I'm happy. So let's take a look at these. I'm going to, this is going to be a longer video because I have not introduced a new position before. So I'm going to detail a little bit of how I made this decision, what I plan to do with it, what my rationale is on trading this style this way, and give a little bit of details on the plan, how I plan to manage this moving forward. So I've done the exact same position, one on SPX and one on INDX. And so we can look at both of these, but essentially they're the exact same thing. And on my brokerage account, Thinkorswim by TD Ameritrade, this trade is described as a back ratio. And that might sound confusing, you might not know that term, but essentially it's a very, very simple concept. All it is I'm selling two naked puts right here at 44.50. And I could just make that trade and just be happy to sell the naked puts. The problem with selling naked puts are, well, let's go model one. So let's come in here, and I'm choosing March, which is a 92 days to expiration. We'll talk about that here in a bit. But if I can go in here to model, and I'll go into more detail if someone would like it on how we can model things and use these Analyze tabs. But for now, I'm not going to go down that particular rabbit hole. That can take a while. But let's say I just went out and I sold two 44.50 puts completely naked. Well, the problem with that is your downside risk is a 45-degree line, which is pretty nasty. So, if we get a large sell-off, and 20% sell-offs can absolutely happen. 5% in one day has happened a couple of times this year, overnight in the futures. 10% in one day can happen. 15% in a day can happen. So this exposes you to a lot of risk, especially if you are using margin. And this is a portfolio margin account, and I won't explain what that is right now. But you can see that I have sold two naked puts, and each one controls 100 shares. And the NASDAQ, the INDX, is almost a $5,000 stock, if you will. It's not actually stock, it's an index that does not have a tradable underlying, but we can trade options on it. And so let's see if I did the math here. Let's go to the calculator. So if I have 100 shares times a $5,000 stock, I'm controlling $500,000 of notional value. And if I do this twice, I'm controlling $1 million of notional value, and I'm being charged $40,000 in margin. Which means if the NDX went to zero, which is incredibly unlikely to happen, I would lose somewhere in the ballpark of $900,000. Now, I'm not going to tell you my account size, but I will let you know it is less than $900,000 by a good amount. So not only would I lose the entire amount, I would be way underwater, and that would be really unpleasant times. In fact, I won't even let my wife see this as a possibility. I've tried to explain this to her. She's not interested. I can see why. So that is the risk of selling naked puts. And now there are lots of analysis and back testing and plenty of studies to indicate that this is a viable strategy, and over the long run this works really, really well. The problem is it only takes one day down here to ruin your life in some instances. So I am not prepared to take on that risk. So instead, I sold these two naked and then bought another three. And you can think of this as selling two naked puts and then buying three for insurance, or you can think of this as a really large, wide vertical spread. So I bought 44.50, or I'm sorry, I sold the 44.50. I bought the 40.50s to make this a vertical, and then I just bought one extra one for downside insurance. So there are multiple ways you could think about this, but the end result is I have this structure. And so my expectation why I'm doing this is we've been in a fairly strong bullish momentum regime lately, and anticipating more upside potential, I want zero upside risk. And so this can rally to infinity, and I can't make more than the 42.82 credit that I sold this for. So I've capped my upside gains if this continues to rally. However, I put the probabilities in my favor, and I don't actually expect us to rally another 10% in the next 90 days. Well, heck, that could happen. I don't expect it to happen. It certainly could happen. So this is a bullish type, and actually that's kind of a funny way, a bullish-ish. So I'm happy if the market rallies, but I'm not going to be participating in the all the upside. I've capped my gains, but in order by doing that, I've given myself quite a bit of cushion to the downside. So not only can I make this entire over $4,000 credit if the market continues to rally, I can make it if we just sit right here and enough days pass between now and March 17th when these options expire. In fact, the market could sell off and stay down in this range. And as long as my loss isn't so large and I can tolerate the little bit of heat and pressure, as the days go by and these options decay down to zero, this purple line is going to move up and up and up and up until it meets the blue line. So we can even be down here. So I could be wrong by 200 points. I could be wrong by 5% of the current price. It could have a 5% drop in my bullish strategy, and I can still make the full profits out of this. Now that's depending on when that happens. That could tell a whole different story. So if we're down 5% tomorrow morning, I'm not going to be anticipating holding this until March, but without doing anything. If we rally way up here, and actually if we got down, if my credit decayed enough so I could buy it back at a lower price, about 25%. So if I can buy it back for 25% of what I sold it for, or make 75% of the credit as a profit, I absolutely would take this off. I don't try to expire this. If I've gotten most of the meat off the bone, I don't want to try to hold on to this for another month or so to try to make the last dollar or so out of this 44 or 42 that I sold. I would much rather take $30 out of this, $20, $30, and as it's down to $10, let someone go else try to sell that for $10. I'm happy to buy it from them for $10, and then I'll go find something else for $40 and I'll go sell that. So that's the theory, that's the strategy. Other ways I could protect this other than buying this extra put. I could just sell the put naked or in a vertical to give it a little bit of defined protection, and then go sell a call against it. The problem with selling a call, especially in the current market, is rallies really hurt, and the call is difficult to manage because as we rally, the volatility, in equities anyway, the volatility tends to come out, and so options are getting cheaper and cheaper. And so if I want to try to roll this call and move it out, there's less juice in the calls I'm trying to roll to, and so I either take a loss or I can roll and increase the size. So let's say I lose $1,000 on this call and I'm going to go move it out somewhere else. Well, I might have to sell $2,000 worth of the new calls to make up for my $1,000 loss and give me $1,000 potential credit. And so I could double my, so I may say sell one call, well, I can go sell two calls. And let's say those calls get in trouble, then I can go sell 4. And if those get in trouble, well, let's just, we can keep doubling. I can sell 8 to 16. And if you have an infinite amount of money and time, then eventually you're going to win. And that'll be great. But if you're selling a naked call or naked put, if you're selling naked options on a $5,000 stock and you double it 2 or 3 times, your position size and your leverage gets pretty large very quickly. And the nights, if you can tolerate a $200 or $300 day, or even a $2,000 or $3,000 day where you're kind of swinging around, if that becomes 20 or 30,000 or 200,000, emotions tend to get very different for people, especially if the 200,000 or the $20,000 number is not is a large it's not part of your plan and constitutes a large percentage of your account size. Then yeah, you definitely have emotional and psychological issues to deal with when the numbers start to get that large. So selling a call naked has worked really well in some regimes for me. When we're in a trading range, that can be really great. Right now, I'm hesitant to do that. So I could do a similar, the same reason I was hesitant to sell a naked put, I could sell a call vertical. And so I might do that. And then, obviously the question is, well, where would you want to do that? can sell it further out of the money, sell it closer to the money. That's a different discussion. I could buy a put vertical. And so I could buy some puts here for protection. I could do it closer to the money. I could do it a little further out of the money. Obviously, the closer to the money, the more expensive that vertical is going to be, which then reduces the amount of credit I can make. The further away, the vertical is cheaper, but it gives me less protection. So that's all trade-off. What's the right answer? Unfortunately, the true answer is it depends, and it's kind of arbitrary. And so you can come up with a whole bunch of different strategies and backtest them, and I'm going to talk about backtesting. But honestly, it really comes down to a somewhat arbitrary decision. You choose something that appeals to you, that makes sense, that you like. Many different option traders trade many different ways. They'll argue with each other and swear which way is best. Through my mentoring, that as I studied under mentors and observed many different traders and their strategies, one of the conclusions I found was the same strategy does not work for everybody. And there are some people that are just absolutely mastered and dialed into a little niche that they've created and a strategy that makes sense in their brain, and they can explain it and teach it and detail it to other people, and those people cannot replicate their results because the psychology of shorter time frames and wanting to be involved and active versus a more passive, longer time frame person. Those are very different personality traits. Those are very different approaches to the market, and those people often cannot trade each other's strategies. So a lot of this will depend on you. And how do you decide or find out what you're good at and what appeals to you? Trial and error. It takes time and experience and practice and a lot of failure, because you have to eliminate what doesn't work, and the only way to do that is to try it and realize you don't like it or it's not working for you, and then cross that one off the list and move on to something else and keep doing that process until you circle in on the thing that works for you. So obviously this has worked for me, and I continue to trade the strategy even though 2016 overall has not been great for me. I continue to do this. I believe in the long-term viability and the probabilities, and that I can do this for several more decades. Okay, so all that aside, how did I choose these strikes? That's always a pertinent question. I chose get rid of that since we were just modeling it. I chose the 4450 and the 4050. How in the world did I come up with those? So if we go look at the option chain in the simulator, actually let's look at the trade page, because I can pull up the entire chain without extraneous information. So first of all, these are several of the choices I had for, I'm looking at gold here. Let's look at NDX. So these are the expiration cycles that I can choose to trade in. I could choose any one of these. So obviously one day is not going to do me any good. So here's January is 36 days remaining, February is 64, March has 92, etc., etc. How did I choose this date? Which of these expirations did I want to trade? Why did I go out to March? 92 days. That seems crazy to a lot of people. Everyone knows that options expire the most in the final 30 days, and especially in the last week. So why not trade a bunch of weeklies? Because that makes sense. That's where options expire. That is true. The classic at the money, or the classic theta decay curve, option decay curve that you might find if you look in a textbook or a beginner's book, that is valid for at the money. Out of the money, options decay quite differently. You can do a search, out of the money option decay, you'll probably, and do an image search, you'll find a graph that looks very, very different. So I like to play out, and there are other reasons. Most people want to be short-term traders for whatever reason. I don't know exactly why. Maybe it's a day trader. That's just the image people have of what a stock market participant is supposed to do. So most people, maybe they want excitement. They want the rush of being active and doing things constantly. So they like the weeklies. They like the closest month expiration. And so it's part of me being a contrarian, and part of me thinking, well, if there's a lot of competition and everyone wants to play in the last week and the last month, why don't I go where they're not? Why don't I go out places they don't want to be? And I could probably find more opportunity out there. And so from my experience, and some of it is testing, some of it is analysis, some of it is theoretical pricing, some of it is actually doing it, and trial and error and actual data pulled from real trades, I have discovered what I like is somewhere to initiate somewhere in the 70 to 90 day range. And so with March here at 92, that's close enough for me. I like it a little better than 64 to initiate one of these longer time frame trades. We had a decent volatility spike after the announcement, and Nasdaq and SPX were selling a little bit. In terms of the overall chart, it's not much of a sell-off, but at least we got a little bit of some selling. The volatility popped up a little bit, so okay, let's go wade into some puts, and so let's look at what I decided to choose. So again, there are numerous reasons and ways you can decide which of all these strikes that are possible to trade. How in the world do you decide which one to choose? My answer again is it's somewhat arbitrary. You'll have people will have almost religious arguments about these things, about which one is ideal, and they will have statistics and tests to back up their answer, or sometimes they just have someone else told me this and that's what they said, so I believe it. So again, there's no right answer, there's no wrong answer. It's you find something that works for you and you learn how to manage it and you can become successful with that. Fantastic. That's the whole goal. That's what you're trying to accomplish. It's not to mimic anyone else. It's to define what you want out of this strategy, what you want out of this as a profession or career or just a side hobby that can generate some passive income. So whatever your goals are, be clear on what that is, and then figure out how do you develop a strategy that matches what that goal is. And so this is what is working for me, because one of my goals, or requirements really, is that I don't want to be in front of the computer for 6.5 hours a day. I don't want to watch tick by tick. I don't want to sweat little small micro movements. I don't want to look at a 1 minute chart or a 5 minute chart. I don't want to trade that way. I want to trade 90-day trades, and you'll see this as we go through the series, as I go day in and day by day and show you how this position is affected, that there are going to be many days where the video is quite short because, hey, position looks fine, nothing to do today. I like those days, and some days those days will make a couple $100. Some days we'll lose a couple $100, but at the end of a couple of months, we'll probably make $2,000 or $3,000. And we had to do pretty much nothing other than put this thing on and then take it off. And that is a strategy that works for my lifestyle. So, how did I choose a 50? And so you can go in Thinkorswim and probably I'm sure other platforms, and you can play with a bunch of theoretical prices. So I can go and look at the probability of expiring out of the money. And so, this option I chose has about an 82% probability of expiring out of the money. So I could make my decision that for, again, some arbitrary reason, I zero in on one of these probabilities of it being out of the money is what I like. Or you can use this, the option Greek delta as a proxy for that, which is what I typically use. And so I just go and look at the delta. And when I was being trained and taught, a lot of people zeroed in on this 10 delta. They liked that a lot. I had a good friend who's done lots of analysis and testing, and from his results, the 12 delta seemed pretty darn good, and even 16 and 20-ish. 20 had some nice returns, but here's basically the trade-off, the pros and cons. The closer and at the money, if you're not aware, is 50. So a 50 delta is currently at the money. So you can go sell something right at the money. What are the odds it's going to be here at expiration is about 50-50, because it could go up or it could go down. Now the further you go away, the higher your probability that this is going to stay out of the money, which means that this option is going to decay down to zero, which means you get to keep all the credit that you sold this for. So where do you want to go? The further away you get, the higher your probability of winning. The closer you get to the at the money, the lower your probability. So you could go out here and say, oh my God, look at this. This is awesome. I have a 99% chance to win. Why wouldn't I want to do that? I look at this. I can collect $1. So that's pretty cool. So I could sell something for $1.50. Maybe I'll get adventurous and go all the way here and sell this for $2. And look at this. I've got a 98.9% probability of winning. That's fantastic. So I could make $2, and I could sell hundreds of these things, because I bet, let's go model it. I bet if I do this and analyze the trade, look at my margin, look at that, $4,000 margin requirement. Holy cow. So here I've got $20 I can make off of this thing. And then let's say we want to do that 100 times. That seems reasonable. So let's do that 100 times. So now, yeah, there we go. $2,000. There's a 99% chance we're going to make $2,000. That sounds pretty amazing. Well, sign me up for that. And well, okay, they're going to charge me, $383,000 a margin, and this is a portfolio margin, which is beneficial margin. And the way portfolio margin works is as this drops, they're going to start. Basically, this is your collateral, and so as this is dropping against your position, they're going to start upping the collateral. They're going to quote one of my buddies, they're going to send Vinny with his baseball bat and come knock on your door for a little more cash out of your account. So this margin requirement could be pretty nasty. And oh my goodness, look at this. So I'm not sure how far I dropped this. Actually, let's just make it. Let's not go crazy over here. Let's just make it a minus 15%. Something that is reasonably could happen in the next couple of months. So here we are down minus 15%. Well, we've got about, according to our little theoretical line here, about a $200,000 loss. So we could lose $200,000 on this $2,000 position. And if the market really got crazy for some reason, obviously we could be we could lose over $1 million on this position. So that is why it's not a very good idea to go out and sell something with a 99% probability, because it only takes 1% of that to happen and you have a really, really difficult lifestyle. So I even found that personally the 10% I didn't like so much. They don't get tested very often, but when they do, it gets kind of painful. And so I've been creeping a little closer, 12, 15, maybe 16. And the other thing that was leading to my decision is looking at the current open interest. And you can go look up what open interest means. Basically just means how liquid are these various strikes. And $58 or 58 contracts was the most. And this is not good open interest. That's one of the problems of going out further in time. But I'll show you SPX, where that is, since it's the most liquid instrument, that problem doesn't affect it. But on NDX, as we get further out in time, it certainly does. And so this is not ideal to have so few open contracts, because these bid-ask spreads are pretty wide anyway. So that was another reason. So I found a strike that had pretty good open interest. It was around the ballpark of what I wanted to trade, so that's how I chose it. And then I had gone in and done some modeling to see how I want my line to swoop, how much credit I want to collect. And it just so happened, I didn't plan it this way, but it just happened, oops, pardon me, that the 5 delta worked pretty well. So selling the 15 and buying the 5 actually came out the way I wanted it to come out. And then that makes it pretty easy to remember. Sell 15, buy 5. And I'll get the structure. And so that is how I chose my expiration cycles, the dates to sell, and that is how I chose the strikes. So I want to touch a little bit on backtesting. So people spend a lot of time and energy talking about and performing backtest. I am not as keen on backtest. So if you ask me how did I backtest this, how often did I backtest, what were my backtest results, frankly, I will tell you I've never backtested this. I've never backtested it in any form or fashion. I don't have any sort of statistical results that I'm anticipating. I don't have any numbers that I'm going to compare this to. In fact, I probably won't even, I'll keep a log of this in Excel, but I'm not even sure that I'll ever go back and do a bunch of analysis on how this trade is performing. Because if it generates the $2,000 to $3,000 that I want, I'm perfectly happy. And if I know how I want to manage and defend it, and sometimes it's going to lose, I'm happy with that too. And how in the world can I say such almost sacrilegious things according to some people and how much data they want to collect? Because the way I've used backtesting is not to generate a detailed report and analysis and a whole bunch of statistics that I anticipate my live trading to mimic. The way I use my backtesting is just proof of concept. And so what I've done, and you can do this with the little think back feature right here in Thinkorswim. And one little side note, if you're not familiar with this this platform and this broker, you can download this and play with it for free. You don't have to create an account. You don't have to fund an account. You can go in and play with these analytical tools. You can do all these sorts of analysis. You can play with these simulated trades, and you can go over here and play with adjust the volatilities, adjust yields and stock prices, adjust your dates. So you can do all sorts of really cool things. And I just as an example of some really cool things you can do, you can even go in and create day steps. And so here I'm, instead of just the expiration and the current day, I created 5 little lines here, and then I can increase the days between these lines because we're going out to 90 days. So let's put about, so let's get close to where we get expiration. So now I've created different lines that are 23 days apart. And so I can come in here, let's go back to the current at the money price. Where did that line go? Oh, sorry, let's get rid of that. I don't want an offset. There we go. So here's our current price. And we can see the purple line is today, December 14th. And then the teal line is January 6th. And we have an orange-ish, reddish line at January 29th, and so on and so forth. You can see how that works. And that's showing you that as time progresses into the future, these lines are going to migrate higher and higher and higher. And so today, where I am, let's look at the this gray line on February 21st. If we're sitting right here, this position, according to the model, will have a profit of $3,776. Well, that's great. And if we move up here, obviously if the market has rallied, well, by then, we'll pretty much have sucked everything we can out of these puts that we sold, and we should take this whole structure off. And of course, by February 21st, even if we've moved down to 4,800 from where we are now, this thing's still up a few $1,000. And then we can see these red vertical lines. So this is going to be my break even. So on February 21st, my break even, and right now the market is, my break even is at 70 or some 70, I'm sorry, 46.70. We're at 46.70 is our break even. Current price right now, 49.20. So we're talking over 200 points lower, 250 points lower approximately. I get to my break even point. Now that is if obviously 2 months have passed by. So that's how time works in our favor on these things. And that's just an example of some cool things you can do with this platform. You can do the same thing with volatility. You can do things with multiple expirations. You can put in days. You can do all sorts of cool stuff. So we'll just go back to our expiration +1. So what I would do, what I'd use with black testing, go to think back, and I would find somewhere, I'd go look at a chart and say, okay, I want to go sell some puts, up in here somewhere. Let's go sell some puts, and let's just see how bad it gets. How bad can it get if I sell them at a really bad time? If I sell them right at the top of a range and we get these big, huge pull-offs, or I'm sorry, sellbacks, pullbacks. And so the way I would do it then is go analyze a bunch of different puts. So when we go back to our discussion of how do you choose which puts, well, I'd go model, well, let's say I sold the 15 delta put. Let's say I sold the 10 and the 5, maybe the 25, the 20 and the 25. Let's put all those, and you can just type them into a spreadsheet and just record the prices as you go through ThinkBack, or you could build some more sophisticated tool if you want to. And you can just see what happens. What happens to the price of these puts depending on the delta that they are. Do you do the same thing for expirations? What happens to the 10 delta put with 36 days to go? What happens to the 10 delta put with 92 days to go? How are those different? And that's a quick, easy way to get a feel for how puts explode when you get major sell-offs, depending on the expiration and depending on how close they are to the money. And if you do that sort of analysis and give it some thought, hopefully you can zero in on the way I have. You can zero in on something that feels comfortable to you. That okay, hey, a 15 delta put out here at 92 days is generally going to be a pretty easy ride. When we can get a pretty good move down, this is not going to be that bad. Maybe we drop 100 points, might be down, 1,600. The volatility increases. Let's say maybe I'm down $2,000. If I'm down $2,000 on a potential $4,000 credit position, that's not so bad. It might start to get a little uncomfortable if the market really looks like it's starting to crack and the big red candles are lining up. But for the most part, being down half my credit is not a big deal. I'm looking to take 3/4 of the credit in an ideal scenario as a profit. So I'm still down less than my average win, so no big deal at all. So that is the benefit to go through and build in some confidence in your strategy and to test it against some bad times. And like I said, it doesn't have to be a thorough test. It can just be a little quick back of the page type of thing. Just throw a few numbers in Excel, run a few calculations, and you can get a feel for which ones hold up a lot better. And so that's what I like, these longer trades. I like these trades that are a little bit wider because it can ride out the bumps. So we can get some pretty big swings back and forth in here. And as long as time is passing, my T+0 line is one way to look at this. Today's line keeps increasing, rising higher and higher. And the spread that I've created and sold, it's going to go from 42 down to 40, down to 30, and eventually it'll decay to 0. I'm not going to try to hold that long, as I talked about previously. I'll be happy to buy it back for $20 or for $10. So another note about backtesting is from my experience in the community I was involved with. There were some people who were they were fantastic backtesters. They were very proficient. They were very enthusiastic about it. They were very adamant that it was a requirement. They spent a lot of time and effort performing backtesting, perfecting their backtesting. Some of them had a very difficult time actually trading. And what I found even more shocking, discouraging from an outside observation point of view, is that they had gone through and tweaked the backtest, and they had these pretty detailed list of statistics and got everything so perfect that they decided, okay, great, let's go make some live trades. And I'm just making up numbers here, but let's say all their backtesting indicate they should expect about a 20% return. And so like, okay, we're going to get a 20% return. That's fantastic. So they went and tested it live or started trading it live. And after a few months, they're getting about a 15% return. What was their conclusion? This strategy is no good. It's not meeting our backtesting requirements. It's underperforming. Scrap it, move on to the next thing. And I'm thinking, you got a 15% return. That's fantastic. And people would climb over their brother for a 15% return. But they built in their mind that everything has to be perfectly matched to this, theoretical backtest they've created, that it's impeding and hampering, and in fact, destroying a valid, live, actual strategy. So that backtesting has its purpose, it has its place, but my opinion is hold it with very loose hands and take the numbers you get out of it with a large grain of salt, and just use it mainly to prove the concept to yourself and to build confidence that that this is a valuable strategy. You can have some expectation that it's going to work, and therefore you're willing to ride out the losses, because you're going to have losses, and you could even have prolonged series of losses. So you really have to be comfortable and confident with the strategy to tolerate those sorts of either drawdowns from profit, or just slow times where it can be weeks or months when things are not seeming to work at all, or they're underperforming. Even just being break even for a few months can start to feel like a drag, and you start looking for the next new shiny object. So I would highly encourage you not to do that. That is counterproductive to your long-term success. Okay, so I was just looking at my notes there. The last thing I want to talk about is how I plan to manage this, and I've talked about it briefly. So what I like to do is, you can call it 50 at 50 or at half. If I get about 50% of this credit, if I'm up 50% of this credit, so let's just round it. So let's say we'll round numbers. So we'll say we got $4,000 credit. So if this position is up $2,000, I'm going to take half my contracts off. And of course, I just have a 1 lot, or I'm sorry, a 2 and a 3. So this is kind of awkward. It could be a 1 and a 2 or a 1 and a 1. So that's going to be a little bit of an awkward, which just shows you I didn't really think about that, since I'm trading a new strategy and test. Oh, and I'm sorry, to backtrack a little bit to the back testing, that just gave me a thought. I didn't go back test all this and do a lot of analysis. What I do nowadays is, because I'm confident and comfortable with the idea that puts decay, and that's where my real edge is, that when I think of a new strategy and I think it might be something that works and might be viable, I put it on live. And so I'll test this live. So we'll just do this for a few months, a few expiration cycles, and we'll see how it goes. And so you can see that one of the drawbacks of that is I hadn't planned out exactly how I want to take this off in smaller fragments. So I will figure that out and get back to you. But around the halfway point, if I am up about $2,000, I'm going to take part of this off in one form or fashion. And then ideally, I would like to take the rest of it off around 75%. So 75%, that's pushing it a little bit. That's a little aggressive to try to stay in this for that long. But we'll see how, and that is all subject to change, which is another part of my plan, is I don't have detailed rules that I follow religiously. I don't have a flow chart of if A then B, which is, people may be ironic. I have a software engineer by training and background, so maybe I'm just a really bad engineer because I don't have that nuanced, planned out, disciplined approach. But I found that trading is an art and a science. And I've learned to embrace the artistic side of that, the creative side. I use my intuition, I use my discretion. And I haven't quantified if I'm actually adding any value to my trading. I'm not even sure how I would quantify that as compared to what baseline. But it's the style that works for me. And if I didn't trade this way, I probably wouldn't trade at all. And then I'd be losing quite a bit of an opportunity cost there. So that's another side note about how I backtest, how I trade, what my philosophy and approach is, and how I manage this position is subject to change. And that entire philosophy is subject to change. I could meet someone next week who convinces me I'm completely wrong and explains to me how I could make better returns with less risk. I will listen to that person and I would change my trading strategy. So all of these things are always subject to change, which that is the attitude and the approach you have to have if you're going to interact with financial markets, investing in any form really, but especially financial markets, stock market, because things move pretty quickly and strategies work for a while and then they don't, and markets change. So that's the best case scenario. If the market just stays here, or if it moves up and we don't have to do much, that's fantastic. That's great. That's super easy. So then the kind of question really becomes, what do we do if this really starts to decline? So using our theoretical model, which is pretty darn good, but not 100% accurate, let's say we do get a pretty good drop. And another little rule of thumb I like to use is when I'm losing about 2 times the credit I'm receiving, that's a big key for me to start to do something. Or another kind of the easy rule of thumb is this 44.50, these puts that I sold. Right now they're $42. If those double, so if these things get close to $80, then it's really time for me to do something. That's one little rule of thumb that I use. And so where am I going to be down about double? Like, right now, I'm down $8,000 somewhere over here, and that's pretty darn far away. So I'm sure I would not wait this long. But somewhere, and maybe I'm not a technical trader, I'm not a chartist really, even though I look at the charts and you can see some squiggly lines and whatnot on here. So here's a little simple something. So here is the bottom of a range that we've been in for a while, the second half of this year. So somewhere in this little band here, we can draw a rectangle. So somewhere, let's say somewhere in there. If NASDAQ breaches below this area, somewhere in here, I would start defending the downside, because who knows what, maybe it just cranks all the way back down to this level. I don't know. Again, I'm not a chartist. I enjoy looking at them, draw some little lines, think I know what I'm talking about, but that's a whole other topic, a whole other thing. For the most part, I don't believe this stuff, but it just gives me a way to manage my position. So, and all this gobbledygook and randomness and who knows what all this means, it just gives me something to hold on to of, hey, here's a line in the sand just to make a decision. Oops. So, I'm sorry, I lost my train of thought there. That was around, wrong charting platform. That was around 46.50 or so. Let's call it 47.46. So if we get somewhere, current price is up here over 4,900. If we start getting out here 47, I'll definitely, especially if it's in the next few days, I would absolutely be looking to take action. Now, again, this goes back to a video I recorded earlier today. How can I best manage this? I can sell a call. I could just sell a naked call and let that get the negative deltas over there, will offset some of my positive deltas in this position, and I get myself into a more neutral position. That's great if the market then comes down and someone drives a nail in it and it just stays in a little range down here. That has not been that's not been the way the market has traded recently. Recently, when we get sell-offs, we get these V reversals, sell off in big massive rally, sell off and rally, sell off in big massive rallies. And when you get sell-offs and big massive rallies, when you get your sell-off and you start selling calls, you get your big massive rally, this call that you sell just absolutely gets destroyed, and you lose so much more money on this call than you're making on these puts that you sold, that this call that you sold just to hedge out this position and help you out on the downside just becomes a complete thorn in your side and can take this entire position and drag it underwater. So selling naked calls requires the highest level of options permissions for most brokers. So selling naked, you cannot do it in an IRA account. You can only do it in a margin account, and most people will be fairly stringent to even allow you to sell naked calls at all. So, of course, then you could sell a call vertical. That would make a lot of sense if you can't sell the call naked, and it would define your risk. So that would be another thing I could do, and then you get to choose. The same way we're selling our puts down here, you could choose where you want to sell that call, or that call vertical. You could sell it close to the money, which would expose you to that whipsaw. You could sell it further away, which then you don't get as much credit and protection if it continues to trend down. So those are all trade-offs. What's the right answer? It depends. It's arbitrary. Something else I could do is I could buy a put vertical. So I could buy some puts closer to the money, or maybe a little bit down here. I could just start buying some put verticals, which would prop up, give me a little more credit, and then just hope it stays within this little new area and not go back above my put verticals. I could sell a whole nother iron condor structure thing on top of this. I could plop a butterfly in here somewhere. So many different things we could do. I tend to, as approach number one, despite the whipsaw potential problems, my first rule of thumb is usually, or first action is usually to sell a call or a call spread. And I'll usually go sell around the 15 delta. Same thing I do on the put side. And then I'll turn this into a neutral position. And then if we start to reverse up to the upside, I start to peel those calls back off. And you can absolutely lose some money in that. But let's say that whole transit, maybe I lose $1,000 trying to hedge this, and I have to take my hedge off, and I lose money on that transaction. Okay, so then that brings my credit down to $3,000, and maybe I can make $1,500 or $2,000 out of that whole thing. I'm not going to cry over that. I'll take the $1,500, $2,000. That's not a big deal. So that's how I plan to defend it on the downside. Another thing we could do is if we get to the point where these puts double in value, and or I'm down 2 times the credit I've received, so our P&L is down about 8,000. I can take these puts and I can move them out. I can roll them away. So I can buy in these 44.50s that I'm short, and I could go sell some at 43.50, or I could sell some at 4,300. Depending on when we get here and what the prices are, that would dictate which strikes I choose. Now you can just roll and take a loss, and just roll these out of vertical, and you'll reduce the amount of credit you have, but you'll still stay in the trade, and you can make some of that money back. Or some people will roll this and increase their number of contracts so that they're rolling, excuse me, either for a flat, or they'll actually roll and receive another credit, which basically means they're just increasing their position size. And if you're increasing your position size and selling more puts into a market sell-off, nasty things can happen. So if you're going to take that strategy, and I might do that one time, maybe twice, be very careful. And excuse me, if that is your strategy, plan ahead in your trade management and your position sizing. And if you're going to roll twice, and that's in your plan, start with a position size that will allow you to make that increase in margin and increase in risk, and still be within your tolerance of your overall portfolio. Because I've seen people, they get upset, emotional, willy-nilly. They just start increasing the size. Market continues to decline. At some point, they can't take it anymore, and the numbers get really nasty, and you end up taking a really big loss, and it is not worth it. It is absolutely not worth it. So that's the plan. That is pretty much it for this one. Let's briefly look at SPX. You can see, it's different strikes. It's a different size contract, but it's the same concept. And so this one, The credit came out to be just over $3,000. On NDX, it was just over $4,000. You can see that my sizes are different here. NDX was short 2 and long 3, and here I doubled. So I've got 4 and 6 in this spread, and I've received less credit because it's a smaller contract. And then looking at the strikes, remember we had such low open interest on NASDAQ. Look out here at SPX, and this is the 92-day. I mean, there are 38,000 contracts on the 2050 and 30,000 on the 1850. So that is massive, massive liquidity. This is not a small product. This is a large product. These are tens of thousands of contracts, and this is at 92 days. If we come in here to December, you've got hundreds of thousands of contracts around the money. So there are millions, billions of dollars in SPX. So you will never, ever run out of liquidity. And just one last note, even if we go look out in March as an ending point here, you see this spread looks really wide. Oh my gosh, it's $1.20 wide. Well, on the electronic platform, you see these wide spreads, but in reality, where it's traded in the pits, I think it's actually just a nickel wide. Maybe it's 10 cents wide, but it's actually incredibly tight market, incredibly efficient. Oh, that's one last thought. One last thing I'll show you is how did I actually execute this? Where did this price come from? So what I did is I basically came in just like this. I built this model with the simulated trade. I looked to see what the current price was. So let's say this is the current price that it's quoting me. I'd never ever try to execute at whatever price is telling me. So I take my simulated trade. I'll create a duplicate order. Since I'm trying to collect a credit, I'm always going to work my price above. So since I'm selling something, I want to sell it higher than what it's telling me. I'll usually go at least 50 cents, but we start with 95. That's it's go close to $17. That's a nice round number. So then I will confirm and send it, and then I'll go in here in my orders. Oh, sorry, that's the filled orders. So here's my current orders. So here I've got it at $16.95. I'll just start canceling and replacing. And we'll drop it down to 90 or 85. So let's say 85, and then I'll drop it down to 80, 75, 65, and start working 60, 55, 45, 40, 35. Just keep doing that until they fill it, because I don't know where the market is. I don't know where the market is until they actually fill it. And I've had occasions where I put this order in and I put it in at 16.85 and it fills immediately. And if you ever fill an option spread immediately, you know you didn't price it correctly. So sometimes I get filled 50 cents above where it's currently quoting. Sometimes I'll have to work this thing all the way down to 15.85. And since this is a brand new position, I don't have to chase the market. And so maybe I'll just make a mental note, or you might come up with something in your trading plan that says, hey, I'm not willing to accept some sort of ratio or some credit versus the margin you're being charged. So maybe you come up and say, look, I'm not going lower than 16. So maybe you work this number down to 16 and it's not filling, and then you just leave it there. And you say, I'll leave it there at $16 for the rest of the day. If it doesn't fill, no big deal. I'll come back tomorrow and I'll try again. Now, in the scenario where this thing is moving down and I want to sell a call or buy, I want to do something to defend my position, well, then I'm just gonna pay up. And if that means I feel like I'm chasing the price a little bit, I'm gonna chase the price a little bit, because there have been too many times where I've been obstinate. I said, this is ridiculous. I don't want to overpay for this protection right now. This is crazy. So I'm just gonna, I'll put it down 50 cents below where it's currently trading and just wait for the price to come to me. The price never comes to me. I never get my protection on. That creates more problems. So I've learned through some hard knocks in my experience, if you're initiating a new position and you feel like you want to wait and just put in a price you like, perfect. You can do that for several days. Just let it sit there. You can put it in a good to cancel. Just say, I'm waiting for this price. I'm going to stay here until I get filled. That's completely valid strategy. If you're trying to adjust or defend your position, pay up. Get your protection on. Get your protection on. And don't worry about the nickels and dimes you might be losing. Worry about the dollars and tens of dollars you could be losing. So don't be too cheap on some of this stuff. Pay up and get your protection on if you need it. All right, that is going to do it for this video. It should be by far the longest one in this series, because tomorrow, for example, we should come in here and say, oh, we didn't do anything, and maybe we made a few bucks. And then hopefully we'll do that for many, many days in a row. And then and since we're 92 days, let's me just have an expectation here that maybe by 2 months from now, when there's, well, it can vary. So maybe with 50 days to go, all the way down to 30-ish days to go, somewhere in there, we should be able to get out of this thing for our full profit. So maybe it could be just a whole bunch of 1-minute videos of nothing to do today. We made some money, and then eventually we'll have our orders in, and they'll take them, and we'll make our profit, and then we'll move on, and we'll do this all over again, and then we'll just keep doing that month after month, month after month, for the rest of our lives, or until the market changes. And it's a nice passive income that we can use to build up a retirement fund with, I think, much less risk and much less stress than trying to balance a portfolio or just pick a mutual fund or hope this nice looking fellow who is my financial advisor actually knows what he's talking about and has my interest at heart and will take care of me. I think this is a much, much better way to go. Put this in your hands. It's not complicated. Well, it is somewhat complicated if you're learning a new skill, new terminology, but once you get over the learning curve of understanding how options work and what they are, this strategy is incredibly simple. And if you come up with some very basic ways to defend it, and a valid way to defend it could be, hey, if I get down, so I've got about $3,000 credit, if this thing gets down $3,000, I'm just going to take a loss and quit and then look for another opportunity to start again. Perfectly valid strategy. That could be a good management strategy. If you are making enough on your winners to offset that loss, that can be perfectly valid. So find something that works for your lifestyle, find something that works for your psychology, find something that you believe in, that you'll stick with, that you'll work on continually and go through several market cycles to see good times and bad times. And I believe this sort of strategy and some little nuances as markets change, this is a long-term wealth builder, a long-term revenue generator, a long-term passive income stream, which is why I am excited about this and why I want to continue to do this despite setbacks and times when I get frustrated and a little discouraged. I'm going to continue doing this because it's been good to me. I believe it will be good to me. I don't think this option market is changing fundamentally anytime soon. This is a valid strategy. This will work. And if it doesn't work and the option markets change, I will change with it. So thank you very much for your patience and indulgence. And if you made it all the way to this far, congratulations. The next video should be very quick and brief, and we can see how this position develops over the next few weeks and months. Thank you.